Good evening, guys. Ken at Taurus Capital, the nightly strategy podcast for February 25th, 2021. The fireworks continue today. Another beautiful day in the neighborhood. We spent some time yesterday talking exactly about this scenario. We took a look at the previous worst one-day sell-off of the last 30 days. We went back about 21 days ago. We had this one where it closed. It closed here, gapped down, sold off harshly to this level, and then rebounded to here. And we said, well, if that's the worst we've seen here lately, what's that look like? And so we hung this one off the top of yesterday's high, right here. So, well, this is how far down it could go. And what we got today was this move. So the margin of error or the degree of fit, pretty darn close. That's how far they can move it in one day. You know, by comparison, 2 days ago, the big sell-off and then recovery was not as bad. And then yesterday's gain and recovery was half of that. And then today it was decisive. So it started off innocently enough, like they always do, with a gap opening down from here to there. It ran up, broke out the top of the yesterday's dragon as if it was going to do this. And instead, it did that. And it did that in a couple legs down. It gave a horrible sell-off, a little bit of a recovery, and then great big sell-off. So there were actually multiple legs intraday to contend with. So it finishes with price here at 382, which means we're more than 2.5% from the swing high. So we're almost 3% off of that top. The yeah. So the fair value, long-term fair value here has rolled all the way up. And for the first time in a long time, we had a close below the long-term fair value, a close below the Bollinger Band mean. Remember, the last time we saw that was at the peak of this sell-off here, and then, but it never even got below the fair value, and then it returned this kind of powerful move. So this is what that now looks like to the downside. It is now closed below the fair value, below the Bollinger Band mean. It's within an inch of the 10-day low, and if that breaks tomorrow, then the belly of the Z1 is here, edge of the river. The dragon belly, the last statistical support measure over here, is at 377. That's only $5 away. Then it is the belly of the RL10, that statistical measure of support, at 374 3/4. And then that's practically a 5% sell-off. So if we were to look at a 5% sell-off level from that swing high, we'd see something like this, 5%, and then that comes over here. So that's really about 374.5. So is all of that in range tomorrow? It sure is. If we just take today's close as a reference point, tomorrow it could very easily get to this price level. All the way down to 372. Almost 371 really. So that's the potential magnitude of the move tomorrow. That would not be surprising. Now, can it go farther than that? Yes, it can, but that would sort of be the maximum non-surprising move right there. So it could give us, it could give us a sell-off to the 10-day low, and then a nice recovery. How big could the recovery be? You could see, well, if you include the gap and then the big run up, I mean, theoretically, this thing could do this. Let's say it came all the way, gap down to the dragon belly, and then turned around and ran up. It could do this. In that scenario, what we'd have is a gap down, and this one would be an orderly sell-off to the 10-day low, and then an intraday reversal, which, if that happened, it could look like this. And then back all the way to the peak of the dragon. Excuse me. So that could give us this kind of a move. It could also go to the edge of the river, or let's just call it the belly of the dragon, then a recovery that looked like this. It could give us a 5% sell-off. And then find support. In which case it would come back to the fair value in the Bollinger Band name. It could give us a gap and sell off to like the 30-day low, which is all the way down to here. Yeah, and then a nice recovery. Well, that would be Mr. Toad's Wild Ride, where it would still end up closing lower than it did today, but it would be just a violent. So that's 4 different scenarios, all of which feature initial morning sell-offs based on overnight news and catastrophic announcements and people getting home looking at end-of-day data and having to sell at any cost. On the other side of this too could be that you get this kind of a favorable gap, like the last time it sold off. It gapped up, all the way here, and then also gave this kind of recovery move. So what would that look like? Well, that would look like a gap tomorrow to, an upside gap to here, and a follow through all the way up to the 10-day high. So that's kind of the magnitude of what tomorrow, even without trying very hard, could look like. So now put yourself in the position of a person who only swing trades and has to contend with that kind of a move. And you got to say to yourself, at these critical states at the ends of long moves, is the market more like this, where it has these big harsh sell-offs? Is that the primary trend? Where it's these kinds of moves? Is that the kind of market I'm in? Or is it this kind of a market where the moves are these favorable swings on net? I mean, is it this kind of a market? So what are we going to see tomorrow? So this is sort of the argument of why day trading is actually lower risk than swing trading, and the combination of day and swing is lower risk because, quite frankly, yesterday's second day follow through got me long again in all the disruptors in my swing portfolio because I had to be postured for the kind of an explosive move that represents. But on the other hand, this kind of day was certainly possible. It starts off orderly. And as price started collapsing through these support levels, every one of those is a vote towards the downside, is an indicator. Next card, up, still going down, still going down, still going down. Well, that means it's turning into that kind of a day. So halfway down the stack, I'm basically market neutral by using the day trading portion of the portfolio to at least get the swing trades to market neutral for the overnight hold, and then with the possibility of making a little bit more intraday. Well, why can that happen? Well, because the intraday trades require less of an initial risk in dollars per share, so the position size can be larger because you're not as worried about the gaps in these liquid movers. So it's very possible to start the day with a swing orientation in one direction, quickly get to value neutral with inverse targets, and then use the intraday momentum as it continues to unfold to make some money, and then be flat on the day trade portfolio and then neutral in the overnight portfolio. So there's no gap risk. That's the essence of day swing hybrid trading. In order to find these turning point moments in the market where volatility dramatically increases, directionality becomes opaque, and the market is looking around to see who's going to take over the leadership and try to uncover what kind of market this really is. And I've sort of outlined in those scenarios the kinds of moves that would be unsurprising tomorrow. So our job is to be not surprised. Our job is to try to see enough possibilities that whichever one unfolds is something that we've already seen, and we've worked through the decisions on those alternate courses of action, and then found the things that we can do to minimize risk and protect positions in those other longer term time frames. That's the essence of hybrid trading. I should think that's lower risk. It's more work, but the same kind of thinking that you have to do to identify reasonable swing targets. If you don't do the day trading or hybrid trading, then you just got to absorb the fact that markets can do this and are going to affect your swing trade. So how wide does your stop have to be? And the wider that stop, the smaller your position size. So you just get more positions. But then you worry about, well, what happens to the correlations in my supposedly widely diversified positions? Because if this really is a turning point, then the correlations that were developed during the previous run up may no longer apply because the market conditions change. So those longer term correlation coefficients break down exactly when you need them to be good. That's when they become bad. We're going to see something like that when we look at the, let me just jump ahead and make this point now while I'm thinking about it. When we look at the daily report, I'm going to show you one. We don't talk about that much, but which is there on every daily. And that has to do with the ADX stat, where we look at the measures of trendiness. Using the ADX, standard ADX10 as the measure of trend. So here's a quick lesson here. So I'm going to come down and look at, let's see, I'm going to come down and look at page 10, the ADX stat, where it performs ADX statistical comparisons to the Dow 30 and ETF 30 populations to examine the strength of trend stats. So ADX stat, examining the ADX 14 statistics compared to the last 500 days. So what this table shows is, this one happens to show the ETFs, because I like using the ETFs of the broad indexes in the world market model as a way to gain insights into larger global effects. And you see where I'm using the standard green, white, yellow, and red formation. So the average ADX of those 30, you would not be surprised to know, is between 0 and 0.2. The boundary between yellow and white. This is where the average ADX statistic is. Now, the volatility of all these different instruments varies, so that's why you have to normalize it using the z-score. So let's see how we read this. The thing I want to notice is that all of the ones that have exceptionally strong ADXs turn out to be the most powerful movers that we've seen lately. These are the ones that have been exceptional. Mixed commodities, because of its strong energy component. Oil, the negative trend in treasuries has been massive. The ADX score of treasuries is 45.9. That turns out to be 2.5 standard deviations abnormally strong. So what do I mean by that? Well, when we come over to our lookup table, we find that this column gives us the average ADX over the last 500 days. And so the ADX is a measure of strength of trend, but not direction. How strongly has that instrument been trending based on ADX 14? Well, the average ADX of treasuries has been 21.9, as you can see, 21.9. And the standard deviation over that time has been 9.2. So average plus one standard deviation is 31.1. So if today's ADX reading in treasuries was 31.1, then that would put it right on the boundary of white and green in terms of its own statistical ADX pattern. And then two standard deviations would put it at 40.3. So you take 21.9 plus 2 times 9.2 would get you to 40.3. Now, the strongest or the largest ADX that it's had in the last 500 days is under Max. The strongest that's ever been was 48.9, and that had a z-score of 2.9. So of the last 500 days, the strongest directional trend in treasuries had a z-score of almost 3 standard deviations. Today's reading of 45.9 is a z-score of 2.6. So that's about as directional a trend as the treasuries have had in the last 500 trading days, or the last approximately almost 2 years. Well, what other ones are having these extraordinary moves? Energy, finance, agriculture, coal, treasuries, oil, and commodities. Extremely directional trends. So if you looked at a chart at their trends, you would quickly see whether that trend is up or down. The energy is up, treasuries are down, finance is up right now because of the promise of $2 trillion. Well, now if we look at the bottom of this thing, what are the ones that are extraordinarily in the red? Oh, this is not good. This is the triple Dow and also the diamonds, the Euro 350, SPY, XLB, Brazil, consumer staples, all of the rock solid elements of the big broad US indexes. And they're trading at ADXs less than 15, and they are all more than 1 standard deviation of weak ADX. Does that mean they're failing? No. What it means is that's the end of a very long trend. And it is going through an intermediate trend change. And it takes time. It takes multiple days for that kind of topping action to occur. What does that look like? It looks like, let's see if we can get this on the sketch screen real quick. So the way ADX works, for those of you keeping score at home, pen tab will get disconnected. That's why the pen wasn't working. All right, so when I have a price action that looks like this, like if yesterday looked like that, and then today looked like this, a little bit higher, and then a little bit lower, and then it closed here. The way ADX is calculated is that you take a look at, you find all of the price today that was below yesterday's low. That's signal to the downside. And then all of the price action, which was higher than yesterday's high, and that's signal to the upside. And then all of today's price action that was contained in yesterday's price action is just noise. It's not directional until it breaks out above or below yesterday's price action. So the way ADX is computed is it compares the size of the up signal versus the down signal, and whichever one is greater, ADX says, oh, it's that kind of a day. So it looks back 14 days and computes all of those negative signal amounts and all the positive signal amounts. And then it measures the amount of price that was below each of the yesterday's lows. And then that becomes the measure of the strength of trend. So if I had some little wobbly sideways market, you can see there's no trend in there because it's equally, it's giving signals of equal magnitude on both sides of it. And so the ADX in that kind of sideways market goes down because there is no strength of trend emerging. So we can take a look at the average and then the upper and lower bounds of plus or minus one standard deviation and compute that as something like, well, this is the range of normal trending when it's just mucking around. And even if this thing starts moving up slightly, the strength of trend that's found in there is going to be contained within average plus or minus one standard deviation. But if this thing is mucking around and then starts slowly grinding upwards, at some point, the fact that it's got this upward grinding action is of sufficiently long duration that now it becomes more than one standard deviation greater than the long-term average, and you can say, probably right about here, when that ADX stat gets above 1.0, then this is really becoming a positive trend to the upside, and we may be able to ride that. And then you can say, in the look-back period, what was the strongest upward ADX, strong trend and up that it ever got to? Well, what we can see in treasuries right now with the Z-score of 2.6, treasuries are the other thing. They are so bad and steeply down that this is almost historically significant negative directional trend. And that downward signal is so strong that it has driven the ADX to extraordinary levels. Well, up until like the start of this week, DIA and IEV and SPY have been very strong. But, and in fact, there was a time when SPY's ADX just 3 or 4 weeks ago was up around plus 35, an extremely powerful upward trend. How strong was that? Well, when it was at 35 and you look at SPY, the average strength trend has been 24.1 and the plus one standard deviation was 31.6. It was almost 2 standard deviations of goodness of upward trending. So if something mucks around and then ends up grinding north and then makes a nice run up, and then it can no longer make those moves, it's unsurprising when the volatility in this transitional period goes up and the directionality gets flat or a day down, a day up, a day down, and the size of those daily moves increases, but it's not gaining new price levels. It's just getting more volatility as it chops sideways and people get nervous. What happens in this kind of transitional market? Well, you see the risk Z falling, warning about the increase of volatility, and you see the ADX rolling over because it's no longer a clear-cut upward directional trend, but starting to get into this choppy sideways stuff. And when you get choppy sideways with increasing volatility, that's a signal that the market condition has changed from grinding bull to parabolic bull to sideways chop to volatile sideways chop, and now suddenly that entire move up starts looking abnormal and people are worried about, dang, is it going to come all the way back or halfway back? That's exactly where we are right now. How far are those moves backward? That's where the Bollinger Band mean framework that we have is so concerned about. What's the Bollinger Band mean of the last 30 days, the middle of the river? So when this strong trend gets way up here and can't push any higher, and we get the two dragon horns, that's why we worry about the reversion to the mean. That reversion to the mean eliminates all the joy on the upside. It increases the volatility, and it brings back to measured support levels where the last time it was there, it supported that move. But now there's scar tissue because of all the people who've lost money in here. And so now fear is much greater than the potential of greed to the upside. And that's why the downward sell-offs are so large and fast. So you have this phenomenon of walking up the steps and then falling out the window. And that's why, as we see this thing getting better and better on the upside, we start being concerned about where to put the support levels so that if it does, as it inevitably does, gives us the sharp out, we have some ledges of safety that protected us on the climb up the mountain and keep us from falling into the chasm. So when you see the ADX looking like, oh, all of these formerly strong things have now moved out of the green and are all the way down in the red, that's telling you that this could very well be one of those rollover moments on the intermediate term time frame. So these are the ones that are strongly trending in the red. These are the ones that are lacking the trend. They have the usually increased volatility and sideways chop and no follow through in either direction. It just becomes a chaotic mess of increasing volatility until somebody says, nope, that's the value, and I'm bringing money in, and I'm going to start buying this thing at every opportunity, and then enough of the naysayers get converted. I guess it's not down. I guess it's going to be up. And then they join the rush, and then that second wave of momentum turns that thing into a nice move up. And because you have people operating at all different kinds of time frames, when they decide to go from the downward orientation to the upward orientation, that changing of their mind is what adds to that volatility that is characteristic of these turning points in the market. This table then on the daily report, looking at a 2-year look back period, allows us to calibrate what normal looks like, which is plus or minus average, plus or minus 1. It gives you a range of ADX strength of trend that's pretty sensitive to short term because it's ADX 14. It's really just looking at the last 3 weeks of trading data. And it tells you what the boundaries of really unbelievably large moves are when you get beyond 2 standard deviations. That's really historically abnormal. And then it also gives you, for deeper reference, what was the worst it ever got, what was the best it ever got, and then what were the Z-scores of those historically maximum and minimum strengths of trend. And this gets updated every day so that the standard deviation now recalibrates the size of those historical moves inside a frame of reference that makes sense in terms of today's reading. So then you can come over here and say, well, here's today's reading on ADX, and then here is the Z-score, and here is a kind of a brute force and ignorant way of rapidly assessing the climate or the seasonality. And so this very much is our traffic set. Remember, 1/3 of the time it's between average and +1. 1/3 is between average and -1 standard deviation, and then only 1/6 of the time is it that weak or that strong. And then each of these are calibrated on the basis of their z-scores and not on their absolute value, because the strength of trend of treasuries is going to be different than of mid caps. Like the mid cap average was 23.5, treasuries was 22. The standard deviation of mid caps was 7.6, but the treasuries was 9.2. So each one of those must be compared against its own history of trendability and its statistical frame of reference. What normalizes these and allows you to compare the relative strength of trend of different instruments is normalizing it against its own z-score. That's the essence of statistical assessment, analysis, and adaptation to dynamic markets. And that's what I wanted to say about that page and about that instrument, and what this means when you see all of these big index. That means all of them in the globe have had a nice run up and are now rolling over with increasing volatility, and we'll see that reflected inside of the cyclic nature of risk Z, which measures the volatility. When you get that upward quiet grinding stage, the daily volatility is actually pretty small. And that's what reduces volatility and makes risk Z go up and say, yeah, as long as this thing is grinding up, that's what the bulls want. And that makes it very favorable for swing trades, because you can have a relatively small sized stop at 2 ATR. ATR is small and it wants to continue to grind. That's why a rising risk Z in the spring or the summer is the most favorable for swinging. But when the volatility starts peaking in, that risk Z quickly rolls over and warns you against the possibility of sell-offs, which we've been saying for at least a week, because risk Z topped out at a z-score of +1 and was reversing backwards. I said, yep, watch out for those, the increasing probability of large adverse volatility moves, which is kind of exactly what we've been seeing. Well, when that happens, you have a time frame that is optimized for the shorter term intraday trading and hybrid trading. It can be used to gain money on its own, but also to be used as a way to hedge against your longer term positions in swing and core positions. So you don't have to be just hunting maximum gains intraday, but just using those kinds of alerts in order to protect your longer term positions. Back to our regularly scheduled program. Hopefully you found that helpful. Let me know if that was a useful discussion. All right, let's get back to detail. All right, so we've seen the fact that we've got this increasingly large volatile multi-directional moves, and that's why I spend the time on the visualizing the 4 different scenarios to the downside, all of which featured, they all featured what could it, if it sold off and then reversed intraday, don't be surprised by that, Ken, but it could also be a big move down followed by a fractional recovery and then another big move down. That's the kind of move that becomes a real bloodbath, where you have an initial big move down, some kind of trivial recovery, and then a secondary collapse. That's the best of all circumstances for intraday trading, because then you're going to see collapsing dragons galore and owl entries to the downside and supported winter crossings. So we're going to see all of those things tomorrow. Okay. Kind of goes without saying that it was a slaughterhouse today. So we'll say it was a slaughterhouse today. There's the S&P. S&P came in at minus 2.4. So that's 2.5% or 2.5 ATRs, because the ATR was right around 1%. So that's a 2.5 ATR adverse net. Ouch. That'll get people's attention. Diamonds lost only 1.74. Treasuries only lost 1.63. That's your risk-free rate of return, which is now collapsed below 138. So that short is really doing well, by the way. Ridiculously good. The Russell and the completion index were worse, 3.6 and 3.7. That's some of those speculative capital was voting to the downside. That's really bad. And then tech lost about 3.5 also. So that's brutal. We'll just look at the things that were worse than the market today. So oil exploration let me zoom in so now we can actually read it a little bit better. Oil exploration minus 3%. The FANGs minus 3.3. So at least the billionaires are suffering. That's good. S&P Tech and commercial real estate 3.5. Consumer discretionary 3.7. S&P biotech 4. Marijuana 4.25. Mexico 4.3, blockchain minus 5%, Brazil 5%, wheat and precious 5. Where was the safety of precious metals today? We wonder. What? All the correlations go to 0, or go to 1.0, and everything fails together. There's some blockchain at almost 6%, Arc Genomics 5.8, Ethereum 6%. And even yesterday's metals, which were so amazing, got crushed today. So there's ARC Innovation, that's the disruptor, 6.4. Clean energy. Remember that when this was at 133 and could do no wrong? 106. It's 30% off that high. Lithium batteries, 7.25. Now let's look at the companies that we love so much. But the intraday mover, so Cliff, 15%, NEO, 10%, US Steel, 9%. So all of the, Alcoa, 6%. Well, these intraday traders start looking like, I'm just going to go from the top of the stack. So the intraday on Cliff, it doesn't take much convincing to see that there is, when you have an orderly sell-off, a rebound, and then it fails through. So right around in here, you should be thinking, oh, collapsing dragon, getting short at around 16. I wonder how far that could go, from 16 to 14.5. That's a 10% sell-off from there. Probably 8% on to this move. An additional 4% in this collapsing dragon down to here. Hey, but what's interesting is if you only traded the supported spring crossing, you probably made money on the long side in Cliff today when it went from here to there. So don't give up the ship. But I want you to notice, especially as the day starts turning to crap, that short at 1560, massive goodness. And then you see, oh, okay, Z3 excursion, second position. Money management, third level. Why not? Probably a fourth position in here. And then just the first Bollinger Band managerial exit right there. bam. And then guess what happens once more? Oh yeah, collapsing dragon, another Z3 excursion, another one, and then a Bollinger Band mean recovery. Massive goodness. Neo, same thing. Not as smooth because it's more of a speculative company anyway. But US Steel, oh, same pattern. Even Tesla, when they gave up the ghost here at a rejection of the PSAR. But you can see there's people still looking for buying opportunities in the 600, willing to hold this price overnight. So we'll see what happens with Tesla. Tomorrow is going to be another wild ride on a intraday Thursday in anticipation of a closeout Friday. Clean energy, collapsing dragons everywhere, everywhere. When you see rejections at the VWAP, God dang, are those important? Because the size of the downward move tells you about the strength of the traders. That if you treat VWAP as the reasonable current fair value, it started here, sold off this far, and then recovered to the VWAP and then rejected. So now you start seeing these elements as the downward excursions. And then the recovery moves are always back towards the VWAP. Here's one that took 2 legs to do it. But when it gets back to that fair value, and then they can't push it through to the other side, a failure to follow through any further now gives you a Z3 pinch and a collapse again, and now that whole move is available to you. And when it got down this far and failed in here and started a second leg down, held, and then a third leg down, that's how you get those low risk multiple entries. The absence of price value on the far side of the VWAP is an indication that when this thing rolls over, it's another set of nausea-inducing rides to the downside. And that's a move from 115 to 105. Right? That's a 10% move in clean energy. Now we know it can go intraday from 105 to 110. That's a 5% move. So tomorrow we'll be interested to see how this thing is going to go. Is this a chance for people to buy clean energy companies on sale? You know, we are clearly into the trading business now on clean energy. That long-term annual grind upward that we enjoyed is over. And the 10% trailing stop that was in the core positions protected those long-term gains against, you know, normal noise on the long-term basis. So those profits have been salted away and put in the warehouse that's guarded for long-term periods of famine. So I want to use today's price action as to illustrate just a number of things. Why the intraday trades, when the market gets crazy in directional intraday, those are the easiest days to day trade because the trends are so clear and one-sided. And that makes the previous swing trades hard to do because the longer-term trend it has weakened and is going into a transitional state. So you just reduce the number and size of swing trades and exploit the shorter-term sharper moves until this thing quiets out. How will you know when those things are starting to trend again? Watch the ADX. When the ADX gets to a massively low number, like in the S&P below 15, and then it crosses back above 15, and you look at the price chart, you'll see which of the trends are starting to emerge. Is it a longer-term downtrend? Then you would see rising ADX and declining prices. But if you saw rising ADX and slowly rising prices, that could be the beginning of the next grinding upward trend. So the ADX is our friend in terms of strength of trend. The risk Z is our friend in terms of relative volatility. and then suitability for swing trading. And then just the Bollinger Band named RLCO-BB framework gives us insights into the magnitudes of moves. And then the seasonality of MACD histogram simplifies that into a seasonal approach. So let's get back to let's go back and look now at the daily report. So we've talked about today's price action. When we look at the dashboard, now we see a number of interesting things. And now this is where statistics allows you to have a almost disinterested, standoffish, scholarly view of what's going on. It's a little bit wiser than the guy who's deep in the middle of the hooking and jabbing of the daily tactical grind. It's easy to allow the emotionality and the volatility of the shorter term trades, where volatility is dominant, to cause you to overreact emotionally. The longer term view of statistics puts that into a context that allows you to study the larger waves. So with that in mind, as we look at this, we'll now see where we are. So we are bullish normal, long term still well overbought, 30-day kind of at the high end of above average. Overheated here now on the 2-week and 2-day cycles. So short-term pain and suffering, but longer term, this is just part of a ordinary sell-off. It hasn't even gotten to a 5% sell-off yet. So those guys would say, hey, dude, this is just noise. But now we can see over here where that little growing season turned out to be not much of a summer follow-through and rolled over pretty quick at 1.0. So now we got to be worried about this. What I actually worry about is when you have, it got to a +2 Z-score, then rolled over big, but only went this far. And now it only got to +1 and is just getting near to the 0 line. Oh, yikes. Is this one of those that could be like this, where now it gets down to Z-1 or beyond? That's what that longer term cycle is of concern. So you couldn't even, it didn't even stay long in the overbought condition. It got to oversold, only a brief moment in overbought, whereas during the grinding up, it stayed overbought a long time. So now it's down here in the bottom of the risk C and NDX, or the NDX period. So now we have tech, Latin American emerging markets on channeling signals, or on overreaction signals. And now look at all the things that are channeling. The U.S. markets, the global markets, the emerging markets, everybody's in a rush now in that oversold business. Well, that's been a good, reliable, long-term swing trade pattern. So this is telling you that it has fallen enough that makes it of interest to the longer-term swing trade buyers who want to buy strength on dip. Well, where's the strength? Oh, here's the strength. Still an abnormally large upward move longer term, and this is only, they would say, a shorter term sell-off that induced the weakness. It's a buy on dip opportunity. Just a week ago, that was a buy on dip opportunity that rewarded. So why is this any different? Well, because this time it's different. Well, these patterns in here have a reliability of about 0.7 year in and year out. So that makes today right into a critical state once more. Here's the ones that are suffering the most. Here's the ones that are suffering the least. If you want to take a look at potential targets just on that relative basis, that gives you some ideas. Now, when we look at the Dow 30 indicator, only one doji all day, but lots of channeling and overreactions here, enough that have extreme sell-offs. And now here's Apple at, it's a 5DD and a channeling and an overreaction, and 2.9 to 1 on a swing trade basis. Amgen still getting smashed, continuing to break down. But, this is interesting. Inside the Dow, there were only two companies that made new 10-day lows today. So even though it felt horrible, it's still inside that yellow zone, which is wide and volatile intraday, but still hasn't hit even routine alert levels on many of these. So there's a 5DD and a 4-to-1 on Home Depot, great American company. If you're a mutual fund manager or a hedge fund manager, you got to own good American companies long term. That now has become more attractive. Even Microsoft, 2.6-to-1, channeling an overreaction. Yeah, maybe it's time I got to buy more Microsoft. In the ETFs, notice there were no breakouts to the upside, but not as many big breakdowns as you might have thought. Staples and utilities broke down. The triple Dow broke down. Latin America broke down. Emerging markets broke down on a 10-day basis. Mexico and Brazil, very sensitive. Mexico broke down, as did Japan. Lots of channeling and overreactions, as you would expect. And then a handful of auto framers that test out well. For the auto framers among us, here's a quick look at the chart. The ones that test out better than 2-to-1 highlighted in dark green, with a reasonable risk based on the size of the ATR and the size of the daily move. On the daily squeezes, only Amgen, and that's not surprising because the size of today's candle said most things had large directional moves today, and so they weren't squeezed and pop. Today was the pop. Today was the pop. It just happened that most of them went down. Starting to see a lot more fall now as the summer has waned and is getting us into the fall, and some that are now even in the zero, below the zero line in the winter. That's where the weakness already is. We already knew Apple and Walmart, and we knew treasuries were horrible. And Brazil and Mexico, that's actually good because they're such great frog champions. They are directional as swings and directional as intraday. That means it's prime time trading season for short-term traders in those ETFs as they settle themselves. And the S&P rolled into the fall and is just starting to roll over. So the directionality starting to become downward, but not painful yet. But here's the ones that are already painfully rolled over in the fall and out of their red river. The Qs, emerging markets, small caps, and tech. Oh, yikes. Those were the ones that were leading the way up, and now they are vigorously getting crushed as people take profits and then reverse and go the other way. More volatility coming. That's what that means. So that's everything I wanted to cover from today, except for this multi-time frame. I mean, you don't need this chart to know just how widespread the pain and suffering was, but there it is. And there's Brazil. Whoops, at minus, I just lost my screen. Oh, yeah, so there's Brazil at, minus 215 on the 2-day NDX. That gives you the idea of the magnitude of that sell-off. So if we now look at Brazil on the 3-month. Yep. Painful sell-off and closed poorly. New 30-day low. So that's going to be a critical state. Now, it could be that you get a 2 or 3 day pop, which is what happened the last time it was here. But then if it falls below that 32.29, then it's really open to a massive move down to the previous dragon belly around 28. So this is like a multi-layered critical state. All right. So that's everything I want to cover for today. Hopefully you found that to be helpful. Putting the swing context into a little more perspective that we hope would be useful to you. Okay, so that's everything I got there. We'll get this published and posted in the usual way. If you found that to be helpful, give me a little note there in the chat box. Otherwise, we will be getting ready for tomorrow.